The rise of Volkswagen in China. Imagine a time when China's streets were filled with bicycles, and cars were a rare luxury. Now, picture a company that saw this landscape and envisioned a future where automobiles would become an integral part of Chinese life. That company was Volkswagen. Volkswagen's early entry into China in 1984, Volkswagen became the first foreign original equipment manufacturer, OEM, to establish production on Chinese soil. This move was part of China's strategy to open up its economy and modernize its industries. By partnering with local companies, Volkswagen aimed to tap into a vast, untapped market, while China sought to acquire advanced automotive technologies and expertise. Joint ventures and market penetration. Volkswagen's strategies centered around forming joint ventures with Chinese partners. The first significant partnership was with Shanghai Automotive Industry Corporation, SAIC, leading to the creation of Shanghai Volkswagen, now known as SAIC Volkswagen. This joint venture allowed Volkswagen to produce vehicles locally, making them more affordable and accessible to Chinese consumers. Another pivotal partnership was with First Automotive Works, FAW, resulting in the establishment of FAW Volkswagen. These collaborations enabled Volkswagen to rapidly expand its footprint across China, offering models that catered to the preferences and needs of Chinese drivers. Dominance in the Chinese auto market. By the late 1990s and early 2000s, Volkswagen had become a household name in China. The company's models, such as the Jetta and Santana, became synonymous with reliability and status. Volkswagen's early and aggressive expansion paid off, securing a significant share of the burgeoning Chinese auto market. The strategic importance of China for Volkswagen. China was not just another market, it became the cornerstone of the company's global strategy. The sheer volume of sales from China contributed substantially to Volkswagen's revenues and global standing. This deep integration into the Chinese market set the stage for both opportunities and challenges in the years to come. Transition to electric vehicles, EVs. As global trends shifted towards sustainability, China emerged as a leader in the adoption of electric vehicles, EVs. Recognizing this shift, Volkswagen invested heavily in developing EVs tailored for the Chinese market. The company's commitment to electrification was evident with the introduction of models like the ID series, aiming to capture the growing demand for clean energy vehicles in China. Challenges and competition. However, Volkswagen's journey in China was not without challenges. The rise of local competitors, such as BYD, introduced new dynamics to the market. These domestic companies leveraged their understanding of local consumer behavior and preferences, offering competitive pricing and innovative features. Additionally, geopolitical tensions and trade policies introduced uncertainties that Volkswagen had to navigate carefully. Volkswagen's early and strategic entry into China positioned it as a dominant player in the world's largest automotive market. Through joint ventures, localized production, and a keen understanding of the market, Volkswagen not only transformed its own fortunes but also played a pivotal role in shaping China's automotive landscape. As the industry transitions towards electrification, Volkswagen's legacy in China serves as both a foundation and a challenge to innovate and maintain its leadership position. The battle for market dominance. Volkswagen's struggle in China. For decades, Volkswagen ruled the Chinese auto market like an undisputed champion. The early partnerships, the local manufacturing, the strategic product placement, everything seemed to work in its favor. But in recent years, a storm has been brewing, and Volkswagen finds itself facing challenges it never anticipated. The rise of domestic competition. One of Volkswagen's greatest advantages in China was always its first-mover advantage. It built trust with Chinese consumers before most foreign brands even considered entering the market. But that advantage is no longer enough. Chinese automakers, once seen as cheap alternatives with lower quality, have rapidly closed the gap. Companies like BYD, NIO, XPeng, and Li Auto are no longer just following in the footsteps of Western automakers. They're setting the pace. 1. BYD, backed by Warren Buffett, has become the world's largest EV producer, even surpassing Tesla in global EV sales. 2. NIO and XPeng, once considered niche startups, now offer high-tech, luxury EVs that challenge the premium European brands. 3. Domestic brands are innovating faster, leveraging cutting-edge battery technology and AI-driven vehicle features to outcompete legacy automakers. The reality? Volkswagen is no longer China's only choice. The shift to electric vehicles, a race Volkswagen is struggling to win. China is not just the world's largest car market, it's also the epicenter of the EV revolution. The Chinese government, anticipating a future without gasoline cars, has pushed aggressive policies to make EVs the norm. 1. Generous EV subsidies for local manufacturers have made Chinese electric cars much cheaper than their foreign competitors. 2. The government has invested heavily in charging infrastructure, making EV adoption more convenient. 3. Consumer demand has shifted rapidly, with EV sales now surpassing gasoline-powered vehicles in many regions. For Volkswagen, this poses a massive problem. 1. Its EV technology lags behind that of Chinese automakers, who have been refining their electric platforms for years. 2. The ID. series, Volkswagen's flagship EV lineup, has struggled to gain traction in China. 3. Pricing has become a major hurdle. While Volkswagen EVs are seen as expensive, domestic brands offer better range and features at lower prices. Volkswagen bet big on the ID.4 and ID.6 models, hoping to carve out a strong foothold in China's EV sector. But sales have not lived up to expectations, with many consumers opting for homegrown brands instead. Tesla. Another unexpected threat. As if competition from Chinese automakers wasn't enough, Tesla's dominance in China adds another layer of difficulty for Volkswagen. 1. Tesla's Shanghai Gigafactory has enabled it to produce EVs at an aggressive scale, lowering costs and increasing accessibility. 2. The Model Y and Model 3 dominate the premium EV segment, a space where Volkswagen hoped to establish itself. 3. Tesla has mastered the direct-to-consumer sales model, avoiding dealerships and cutting costs in ways that traditional automakers struggle to replicate. Volkswagen is now in an uncomfortable position, caught between China's homegrown EV giants and a Tesla machine that refuses to slow down. China's changing consumer preferences. Another challenge Volkswagen faces is the changing mindset of Chinese consumers. 1. Younger buyers prioritize technology over brand legacy. 1. Volkswagen's long history in China no longer guarantees loyalty. 2. Car ownership is evolving, with more consumers exploring EV leasing, car sharing, and direct sales models that don't align with Volkswagen's traditional dealership model. 3. Connectivity and software-driven cars are becoming key selling points, and Volkswagen has struggled to keep up with the fast-paced innovation seen in Chinese brands. The political and economic landscape beyond competition, geopolitics and economic shifts have created new hurdles for Volkswagen's China operations. 1. US-China tensions have disrupted global supply chains, making manufacturing and component sourcing more difficult. 2. The Chinese government's push for self-sufficiency in key industries means there is less reliance on foreign automakers. 3. The global economy's uncertainty, rising interest rates, and inflation concerns have made consumers more price-sensitive than ever. Volkswagen, once untouchable in China, is now in one of the biggest fights for survival in its history. Can Volkswagen adapt? To counter these challenges, Volkswagen is making several strategic moves. 1. Investing $700 million in XPeng, a Chinese EV startup, in hopes of fast-tracking its EV technology and market presence. 2. Shifting to a more localized approach, giving more decision-making power to its China operations rather than relying on decisions from Germany. 3. Ramping up battery production partnerships to lower EV costs and improve supply chain stability. 4. Exploring software-driven innovations, including AI-based driving assistance, in an effort to match local competitors' tech capabilities. But will it be enough? Volkswagen is trying to reinvent itself in a market it once dominated. But with China's aggressive EV adoption, rising domestic competitors, and a rapidly changing economic landscape, the future remains uncertain. In the final part, we'll break down what Volkswagen's future in China might look like, whether it can reclaim its position, and what this battle means for the global auto industry. Can Volkswagen still win in China? The road ahead. For decades, Volkswagen was the king of China's auto market, a foreign brand that became more Chinese than some domestic manufacturers. But today, it finds itself in the middle of a brutal fight for survival. With Chinese EV makers dominating sales, Tesla setting new benchmarks, and government policies favoring local innovation, Volkswagen faces a tough reality: adapt fast or become irrelevant. So, what happens next? Can Volkswagen make a comeback, or is its reign in China coming to an end? Volkswagen's last stand. Key strategies to stay in the game. Volkswagen is not giving up without a fight. The company has launched a multi-billion-dollar plan to regain its competitive edge, focusing on three key areas. 1. Betting on local partnerships. The XPeng investment. Volkswagen has finally admitted that it can't win this battle alone. Instead of trying to outcompete Chinese EV startups, it's now partnering with them. 1. In 2023, Volkswagen announced a $700 million investment in XPeng, one of China's fastest-growing EV brands. 2. This partnership allows Volkswagen to leverage XPeng's expertise in EVs and smart car technology, accelerating its own innovation process. 3. Volkswagen will co-develop two new EV models based on XPeng's cutting-edge technology, set to launch in 2026. This move signals a major shift in Volkswagen's China strategy. It's no longer just a foreign automaker selling cars. It's aligning itself with local expertise to survive. 2. The push for affordable EVs. One of Volkswagen's biggest weaknesses in China has been pricing. 1. Chinese EV brands like BYD offer feature-packed electric cars at much lower prices than Volkswagen's premium models. 2. Tesla has aggressively cut prices, making its vehicles more accessible to Chinese consumers. 3. Volkswagen, on the other hand, has struggled to keep its ID. series competitive, with high production costs limiting its ability to match rivals on price. To fix this, Volkswagen is 1. Developing lower-cost EV models, aiming to compete in the sub-$25,000 market where Chinese brands dominate. 2. Scaling up local battery production, partnering with Chinese suppliers to reduce dependency on costly European components. 3. Simplifying designs and production processes, cutting costs without sacrificing quality. Volkswagen no longer has the luxury of relying on its brand name. It must now compete on price, performance, and technology like everyone else. 3. Building cars that feel more Chinese. For years, Volkswagen's global headquarters in Germany dictated what kinds of cars were sold in China. That's changing fast. Volkswagen is now giving more control to its Chinese leadership, allowing them to 1. Develop China-specific models tailored to local tastes and driving habits. 2. Improve smart technology. Chinese consumers demand advanced AI assistance, voice controls, and cutting-edge infotainment systems. 3. Invest in connectivity and autonomous driving, areas where local brands have a major edge. Instead of simply selling German-engineered cars in China, Volkswagen is trying to blend local innovation with its global expertise. Challenges Volkswagen still faces. Even with these bold moves, Volkswagen's future in China is far from guaranteed. It still faces three major risks. 1. The EV transition is moving too fast. Volkswagen has historically been slow to adapt to new trends. The company underestimated how quickly China would shift to electric vehicles, and now it's struggling to catch up. 1. In 2023, over 60% of new cars sold in major Chinese cities were EVs, a staggering transformation in just a few years. 2. By 2035, China plans to phase out new gasoline car sales entirely. 3. Volkswagen's internal combustion engine, ICE, dominance means little in a market that's rapidly moving beyond gas-powered cars. If Volkswagen doesn't accelerate its EV rollout, it risks becoming irrelevant in China's future auto market. 2. Political and economic uncertainty. Geopolitical tensions between China, the US, and Europe could also complicate Volkswagen's strategy. 1. Trade restrictions or new tariffs could impact supply chains and production costs. 2. The Chinese government is heavily backing domestic brands, meaning Volkswagen might not get the same support it once did. 3. A potential slowdown in China's economy could reduce car demand overall, making competition even fiercer. Volkswagen is not just competing against other automakers, it's navigating a complex geopolitical landscape that could shift at any moment. 3. Consumer perception. Can Volkswagen stay relevant? One of Volkswagen's biggest assets in China has always been trust. But the new generation of Chinese consumers doesn't have the same loyalty to foreign brands. 1. Younger buyers are drawn to cutting-edge technology, and Chinese EV brands are leading the innovation race. 2. Brand legacy doesn't carry as much weight anymore. Performance, price, and software matter more. 3. Volkswagen's premium European car image could become a liability if it can't match local competitors in key features. The bigger picture. What this means for the global auto industry. Volkswagen's battle in China is not just about one company. It's a test case for the entire global auto industry. 1. Can legacy automakers survive in a world where software and AI define car performance? 2. Will global car brands remain relevant, or will Chinese automakers eventually dominate international markets? 3. Does Volkswagen's struggle signal the end of European dominance in the auto sector? If Volkswagen fails in China, it could lose its position as the world's largest automaker, a title it has fought to maintain for years. But if it successfully adapts, it could set a blueprint for how traditional carmakers can compete in the new age of electric and AI-driven vehicles. Will Volkswagen survive? Volkswagen is at a critical crossroads. It either reinvents itself and fights back or risks fading into irrelevance in the world's biggest auto market. The investments in XPeng, cheaper EVs, and localized production show that Volkswagen understands the stakes. But in a market moving at lightning speed, it's still unclear whether these changes will be too little, too late. One thing is certain. The future of Volkswagen, and perhaps the global auto industry, will be decided in China. What do you think? Can Volkswagen make a comeback, or is it too late to reclaim its dominance? Drop a comment and let's discuss. And if you found this deep dive insightful, don't forget to like and subscribe for more in-depth analysis on the world of business, technology, and global markets. See you in the next video.